In July 2025, the US government quietly changed the tax rules for millions of people. Most have no idea this happened, and some of these changes are already affecting your 2026 tax return right now. Here's what changed, and more importantly, what to do about it before it costs you. Every year around tax season, millions of Americans sit down, open their tax software, and go through the same routine. They enter their income, they check their deductions, and they wait for that number, the refund. But this year, something is different, and the people who don't know about it are going to feel it in their wallets. In 2025, a law called the One Big Beautiful Bill Act, yes, that's the real name, was signed into law, and buried inside it were major changes to how individual taxes work in the United States. This isn't about loopholes for billionaires. This affects everyday earners, middle-income families, people who donate to charity, people who've never heard the words tax legislation in their life, people like you. Here's the problem. When a new tax law passes, the IRS doesn't send you a letter. The government doesn't run an ad. There's no notification on your phone. You only find out when you go to file, and the numbers don't add up the way you expected. Imagine this. You've been donating to your church every month for 3 years. You always deduct it. It always reduces your tax bill by a couple $100s. But this year, you file, and that deduction is gone, or smaller, and you don't know why. That's not a made-up scenario. That's what the new law actually does for millions of taxpayers who itemize charitable contributions. And here's where it gets interesting. That's just one of the changes. There are at least 3 others that could affect you directly, depending on what you earn, how you file, and what deductions you've been relying on. Let me break them down, one by one, in plain English. Change number 1, the charitable deduction floor. Under the old rules, if you itemized your taxes, meaning you listed out your deductions instead of taking the standard deduction, you could deduct every dollar you donated to qualifying charities, dollar for dollar. Under the new rules, there's a floor. Your charitable deduction only counts if it exceeds 0.5% of your adjusted gross income. That's a term worth knowing. Your AGI is basically your total income before most deductions. Let's make this real. Say you earn $60,000 a year. 0.5% of that is $300. That means the first $300 of your charitable donations this year doesn't count for tax purposes. It's only the donations above that threshold that reduce your taxable income. For someone donating $1,000 to charity, that's a $300 reduction in the amount that qualifies. At a 22% tax bracket, you just lost about $66 in tax savings you were counting on. Doesn't sound like much? Multiply that by 30 million itemizing households. This change is significant at scale, and it sneaks up on individuals who never saw it coming. Change number 2. The 2017 tax cuts are now permanent. In 2017, the Tax Cuts and Jobs Act, often called the TCJA, made a lot of changes that were only temporary. They were set to expire. In fact, many of them were scheduled to sunset in 2026, which would have meant tax rates going back up for most brackets. The new law made most of those provisions permanent. So what does that mean for you? For most middle-income earners, your individual tax rates stay lower than they would have been under the old pre-2017 structure. The standard deduction stays higher, roughly $15,000 for single filers and $30,000 for married couples filing jointly. But here's what most people miss, and this is where it gets really interesting. Making those provisions permanent also means certain other deductions stay capped. The SALT deduction, that's state and local taxes, remains capped at $10,000 per year. If you live in a high-tax state like New York, California, or Jersey, and you were hoping that cap would be lifted, it wasn't, at least not fully. So while your rates may stay low, the ceiling on what you can deduct from state and local taxes stays tight. That trade-off affects people differently depending on where they live. Change number 3. who actually wins and who quietly loses. Let's talk real numbers because that's the only way this matters. Earners in the $40,000 to $80,000 range are likely to see little net change from the permanency of lower rates because that benefit existed before and they were already factoring it into their finances. The people who notice the most change are in two groups. Group 1, charitable donors who itemize. Because of the 0.5% AGI floor, their deduction is now smaller than expected. If they didn't update their withholding or estimated taxes to account for this, their refund shrinks or they owe more. Group 2, high earners in high tax states. The SALT cap staying at $10,000 continues to hurt people who pay, say, $18,000 in state and local taxes. They can only deduct $10,000 of that. The other $8,000 doesn't count. That's real money left on the table. So if you're nodding along right now, you might be wondering, what do I actually do about this? Here's what most people will get wrong when filing this year. Mistake 1, not updating their W-4 withholding. If the law changed how your deductions work, your old withholding may no longer be accurate. People who don't update it will either underwithhold, meaning they owe money, or overwithhold and lose the use of that money all year. Mistake 2, assuming their 2025 filing strategy works in 2026. Tax software helps, but it assumes you know what changed. If you're using the same strategy as last year without accounting for the charitable deduction floor or SALT cap interactions, you're guessing. Mistake 3, not reviewing whether to itemize at all. With the standard deduction still high, many people who itemize this year would actually be better off taking the standard deduction because their itemized deductions no longer add up to more than the standard amount, but they keep itemizing out of habit. That habit could cost hundreds.
Here's your 3-step action plan. Simple, specific. Do these before you file. Step 1. Calculate your 0.5% AGI threshold. Take your total income before deductions and multiply by 0.005. That's your charitable deduction floor. Any donations below that number won't help you. Adjust your expectations accordingly. Step 2. Run the standard versus itemized comparison. Before you go down the path of itemizing, add up all your potential deductions: mortgage interest, state taxes capped at $10,000, charitable donations above your floor, and anything else. If that number doesn't beat the standard deduction of $15,000 single or $30,000 married, stop itemizing. Take the standard deduction. It's faster, simpler, and gives you more. Step 3. Update your W-4 or adjust estimated taxes. If you're a salaried employee, log into your payroll portal and rerun the IRS W-4 estimator. If you're self-employed, recalculate your quarterly estimated tax payments. Getting this right now means no ugly surprises next April. 3 steps. That's it. But most people won't do any of them because they don't know the rules changed. Now you do. And honestly, that's the real advantage here. Not knowing more than the average person, knowing it earlier, acting on it before it costs you. If you found this useful, subscribe, because this is exactly what we do here. Every major money change, every new law, every financial shift that affects your paycheck, we break it down in plain English before it hits your wallet. The next video covers something most people don't think about until it's too late. You won't want to miss it.